This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
Super Investors is brought to you by the Felder Report. When I'm not interviewing one of the most interesting minds in the world of finance, I'm doing a ton of reading and research. I put together some of the most interesting things that I find into a Saturday morning email that I send out free. If you're interested in subscribing to something like this, just go to thefelderreport.com. Right there on the homepage, click Join Now, and you'll be good to go. Known as one of the greatest financial historians alive, Edward Chancellor has been working in the markets for 3 decades now. His study of finance theory, speculative bubbles, and economics goes back even further. The Price of Time, Edward's latest book, is clear evidence of his passion for the subject of financial history and his ability to convey the key concepts in an effective and uniquely entertaining way. The book does a masterful job of chronicling the modern history of easy money and explaining its many secondary consequences, including the collapse of productivity growth, unaffordable housing, rising inequality, the loss of market competition, and financial fragility. More than that, it takes the reader on a journey from the beginnings of modern central banking in John Law's Mississippi Company to today's fight against rapidly rising inflation pressures, imploring the reader to think critically about what it all means for the future of the economy and markets. In this episode, Edward shares his inspiration for writing it and his thoughts on what history suggests may lie ahead. So please enjoy my conversation with Edward Chancellor.
You ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
Edward, welcome to the show.
Peace be with you.
You know, I think it was almost 4 years ago, I read a piece that you wrote for Reuters titled The Mother of All Speculative Bubbles, which I think really hit the nail on the head. And I think it even may have mentioned that it was part of your efforts in putting together your new book. So when Jonathan Tepper reached out to me to tell me about the book and to put us together, I was really ecstatic. So thank you for being here.
Good. Well, we can talk about bubbles and interest later in our conversation.
Terrific. Before we get to the book, I'm curious to know more about the author. Tell me a bit about yourself. You studied modern history, is that right?
Yeah, I the English say read. I read history at Cambridge, specializing in 18th century European history, and then did a postgraduate degree also in 18th century European history at Oxford. And that ended in the early 90s, whereupon I decided not to become an academic, but earn a living. So I went into the City of London as an investment banker, working for Lazards, but I didn't really like investment banking. So I quit that after a couple of years and then started writing. And given my background as a historian, I find myself sort of drawn into working primarily from a sort of financial history perspective.
Well, it's clear that history is a deep passion. Just the book is so thoroughly researched. But you said, you went into finance to earn a living, but was there something specifically that drew you to finance as a career?
Well, I suppose that I thought that if one needed to earn a living, one might as well try and make money from money, so to speak. Right. Which is actually something, as I mentioned in the book, was Aristotle's criticism of charging interest. So I was being sort of anti-Aristotelian in my choice of career.
Well, it's something that I wrestle with. I started at Bear Stearns in the 90s, and I've thought that working in trying to make money out of money, as you put it, is it can be a pretty shallow way of earning a living. But for me, it was really, I think Paul Tudor Jones talked about when he was in college, he was very interested in games and backgammon and these things. And somebody said, well, if you're interested in games, let me introduce you to the greatest game there is to play. And that's the markets and futures trading.
Yes. Well, I mean, just so I then, having written a history of financial speculation in the 1990s, I then sort of got drawn onto, what we call the buy side, onto the investment side, working, doing some sort of consultancy work for hedge funds, and then later working for GMO in Boston as in their asset allocation team. So I think my mistake in when I started out in finance was going into investment banking, or what we used to call corporate finance, which which didn't suit me. But I think on the investment side, that is a different business. It's intellectually extraordinarily rich, multidisciplinary, and really that there is there's no end to the learning process once one thinks of once one thinks of the world through the sort of lens of investment, through the lens of investment. I did read yesterday that Schumpeter said that the stock exchange was a poor substitute for the Holy Grail. But aside from that, I think there's a huge amount to be learned from thinking about markets.
Right, and you mentioned GMO. So when I saw that in your bio, I thought that would be a pretty natural, relationship to work with Jeremy Grantham, who's done so much wonderful work on bubbles and these things. Was working with him part of what drew you there? Or was it something else?
Yeah, well, I mean, let me tell you. So I wrote this book, Devil Take the Hindmost, which is a history of financial speculation, that came out just at just towards the peak of the dot-com bubble. I think it was published in the summer of '99, and at the time, the quant investors and GMO under Jeremy Grantham is largely a quant shop, but there were other quant investors like Rob Arnott, who was at the time had an outfit called First Quadrant, now called Research Affiliates, and Clive Asnis at AQR. And suddenly I had all these quants knocking on my door because they were looking, the quants were aghast at the speculative bubble. They were underweight the tech stocks at the time. And they were very pleased that a financial historian had come along and given a bit of, if you will, sort of anecdotal support for the for the quant message that they were putting across. And at that time, I got to know Jeremy. I worked as a journalist in New York in 2005-06, and I wrote a specialist report on the credit boom for a hedge fund manager called Chris Binodi in London, which we published in 2005. Called Crunch Time for Credit, and I gave Jeremy a copy of this report, and really then that sort of led to the conversation in which Jeremy hired me.
Well, let's get to the book. I have to tell you, I have a belief that the majority of business and finance books should probably just be essays or papers. Most of them just don't have the substance nor the quality of writing to justify a whole book. But The Price of Time is one of the true exceptions. I really enjoyed reading it. I learned a great deal from it. But I have to ask you, what was the inspiration for writing it? Was there something specific that happened in your career? Was there a moment in time when you said, I have to write this book?
Well, after I suppose when I was doing the work on the credit boom in 2003, 4, and 5, I did come to the view then that that credit boom was principally engendered by the very low interest rates that were set by the Federal Reserve after the dot-com bust. Right. Anyhow, and I also became quite sort of interested in Hyman Minsky and his financial instability hypothesis. But then we had the crisis, and interest rates were taken down even lower. As I said, I was at GMO at the time. We saw the stock markets and the financial markets rebound very rapidly. And I suppose I felt that we thought we could model bond yield. We thought we could provide forecasts for bond markets based on sort of mean reversion models, and I realized that our forecasting wasn't at all good on the bond front. It had a good track record historically on the equity side, and so I got into sort of thinking more about that we didn't really know enough about interest rates, about long-term rates, and we didn't really understand bond market cycles. And then, if you remember, there was massive resurgence of so-called carry trades, international carry trades. People after the financial crisis, people borrowing in dollars and lending in emerging markets, and we saw a lot of yield chasing, of people taking sort of what appeared to be sort of large amounts of risk in order to enhance yield. We saw US stock markets rise to record valuations, or close to record valuations, certainly by last year, but very inflated against the historical average from 2010 onwards. And then on the economic front, one noticed a sort of an extraordinary lackluster economic performance. So we found that the financial markets bounced back, aided by the monetary policies of the Federal Reserve, but the real economy, if we can talk of such a thing, sort of remained not exactly flat on its back. Employment recovered, but there was no productivity growth. And so I decided to come back to England a few years ago, 2014, and I left GMO to go back to writing. And by about 2015, I came to the conclusion that you couldn't really understand what was going on in the financial world, and you couldn't really understand what was going on in the economy, and you couldn't really understand a lot of the sort of social and political developments, the incipient rise of what people dismiss as populism, sort of popular discontent with the system. You couldn't really understand any of those if you didn't have a proper grasp of what interest was, what it did, and what the effects on civilization were of taking interest rates down to the lowest level in history. So that really became my starting point. And as you say, it's not really, you can't really cover all that in a single paper. And so this is really an intellectual voyage that starts in Mesopotamia in the 3rd millennium BC and then runs through to the current day.
Well, the book is a wonderful chronicle of the history of easy money in modern times. But there was a point when I was reading it where I thought, the book feels like it was almost written for posterity, like it was intended to explain to a reader in the distant future how we could possibly have gotten so far off course, like the Great Crash 1929 or something. But then very near the end of the book, you write, quote, "So far, each step we have taken on this new road to serfdom has been incremental and justified on the grounds of expediency. Little thought has been given to the general direction in which we've been traveling. There is no grand master plan, unlike Marxism, to concentrate minds. Rather, we've blundered, to use Hayek's term, into greater government control of the economy. And the more we blunder, the more the system appears to fail, which in turn justifies further interventions." Was that your intent in writing? It was to really get people to stop and take a hard and close look at this road that we're on with monetary policy?
Yes, I mean, when one writes, it's very difficult to know why one writes a book, because certainly there's not much financial inducement to do it. So perhaps there is the vanity of the author, who hopes that they might produce something of lasting worth. And what I'm hoping to do in this book is not just provide a framework for understanding the really most phenomenally important concept of interest, but also really a snapshot of the financial developments of the last decade as seen through the prism of these ultra low rates, for which, as I've said before, seem to be the sort of determining factor of so many developments. So, if you will, it's a sort of first take on recent history, and the test will be. I don't know whether I'll be alive then, but in 20 or 30 years' time, whether this still attracts some attention, and even if it doesn't attract much attention, I suppose it'll find a place in a library, and someone will dig, sort of future incarnation of myself will dig it out when they're trying to understand what went on in the 2010s.
Right. Well, it already has an important place in my library. So, but I think maybe it would be helpful to just, the book is called The Price of Time. What is the price of time? I think it might just help listeners to hear you simply explain the title, which may be obvious to some and not so obvious to others.
Well, the thing is that interest has a number of different definitions. Sometimes people talk about interest being a discount rate or a capitalization rate for valuing businesses. It can also be the hurdle rate for investments and for the allocation of capital. It can incorporate a risk factor. So I cite one definition of interest being the price of anxiety. It's the cost at which people borrow, and therefore the price of leverage. So you can see there are sort of a number of different potential definitions of interest. But I was looking for something that was more, that encompassed everything, all these various definitions, and perhaps even more. People have occasionally, and I think rather loosely, unthinkingly, referred to interest as the price of money. But what it is, it's the price for the use of money or even any other asset over a period of time. And time is the important factor. As I mentioned in the early chapters, the charging of interest in the ancient world was criticized by very distinguished philosophers such as Aristotle and Plato, and later by the medieval theologians, the scholars who borrowed largely from Aristotle. And they said that that the lender shouldn't charge more than he or she had given at the outset, that this was a sort of an illicit transaction. As we were saying earlier, the making of money from money, because as Aristotle said, money is inherently barren, and a view that really sort of later found expression in sort of Marxism, where all value comes from labor. But then one I think 13th or 14th century English scholar called Thomas of Cobham made this insightful comment that the usurer, usury being the term for a sort of illicit charge of interest, that the usurer was a seller of time, and that this was wrong, said Thomas of Cobham, because time belongs to God. Well, I mean, perhaps that's an acceptable view in medieval Christendom, but once the Renaissance comes along, and you put sort of mankind at the center of your civilization, not God, then time belongs to man. Time is man's most precious possession, and so that the price of time is what I see as the most important and encompassing definition of interest. And why it's important is because finance, people have a tendency to forget this, but finance is all about transactions across time. It's an intertemporal system. It allows us to take our current wealth and transfer that wealth, our spending, across time. So we can save, we can invest, we can draw our consumption from the future into the present, we can defer it, and something is needed to coordinate these transactions. At one point, if you remember, I asked the reader to imagine a bridge across time in which there is a two-way traffic from the present to the future and from the future to the present, whether we're shifting our savings or borrowing to take our consumption from the future into the present day. And I'm saying that the interest charge is like a sort of toll on the traffic on this bridge, because if you don't have some sort of charge for time, the intertemporal coordination, if I can use a slightly jargonish term, that this intertemporal coordination of a very complex system will cease to function. And I think, in a nutshell, all our current economic and financial problems can be described as problems of sort of intertemporal disequilibrium, or if you want, just disequilibrium, and that's I say why we need interest. It's true, as you say, that the thrust of the argument is about easy money and the ill effects of easy money, but that's really only because we have been living through a particular period of extraordinarily easy money. The search for the holy grail is to find a rate of interest that is just, because in the end we're dealing with a problem not just of sort of intertemporal equilibrium and communication, but also to do with fairness, and interest is something that balances the if you will the interest of the lender and with the interests of the borrower, and one needs to have a fair rate to satisfy both parties.
Well, that's the perfect lead-in to my next question. So thank you, and I'm glad you brought up the bridge metaphor, because I think that was really an insight, something I made a note in the book, because it's really an insightful way to think about interest. But you write, excuse me, quote, "Interest is the difference in monetary values across time, the rate at which present consumption is exchanged for future consumption. Interest represents the time value of money." Later on, you write that during the 17th century, quote, "a consensus emerged among English practitioners of political arithmetic that interest was much like any other price, whose level should be determined by buyers and sellers in the market rather than by government fiat." Why is this concept of the natural rate so crucial?
Well, it's an interesting point when you use the term natural rate, because they would have, and when we're talking about 17th century writers, I mention in particular the philosopher John Locke, who wrote a very interesting pamphlet on the consequences of lowering the lowering of interest, in which he pointed out the problems that might be caused if interest were reduced below this this level that it would naturally find in the market from borrowers and sellers meeting each other. So this is the 17th century natural rate is a market determined rate. And at the time, there were calls to lower the legal level maximum rate of interest. There were still usury laws that in Britain at the time that set in Law's day the maximum rate of interest at 6%, and people were calling for it to be moved to 4%. And Law was saying, well, that would be below its market rate and problems would happen. I think what happens, when we get into a sort of more academic age of professional economists, the natural rate, it takes on a slightly different, perhaps more than a slightly different meaning. Becomes a reference for what is deemed to be the equilibrium rate of an economy, reflecting its inherent return on capital and various other factors. I think the early economists were moving towards were part of a period that was looking towards natural rights and natural laws, away from sort of divine, away from a society sort of governed by divine injunctions. And it was John Locke's taking this viewpoint and extending it into the area of finance. And I think that people, I've had a bit of a correspondence since I published the book with an economist friend of mine called Andrew Smithers, and people some people are questioning the whether a natural rate exists in the sense of in the sense that the modern economists mean it. But I think certainly there must be a rate in which interest is determined by people operating in the market, as opposed to, that doesn't necessarily reflect a sort of an equilibrium rate of a static economy, but it would just be the rate at which people transacted, so to speak, fairly.
Well, it actually reminds me of a quote about, I'm going to botch it, but it was something about, I don't know how to define pornography, but I know it when I see it. I think, I can't define the natural level of interest rates, but I know when they're too low, right? There are obvious signs of when rates are too low. And sadly, I think we've had firsthand personal experience with the damage caused by forcing rates below their natural level. But as you point out, it's astounding to me that several centuries ago, John Locke pointed out the consequences of this. What were some of the things that he warned about?
Well, John Locke thought there would be a profusion of bankers, and that it would be to their advantage, but not to other people's. He thought that widows and orphans would suffer. He thought that house prices would be affected. In fact, actually, interestingly, when people were arguing for lower and lower interest in the 17th century, there were two sets of people who were arguing. One were the sort of indebted landlords, the nobles who wanted higher land values so they could borrow more money, and the other were the city merchants who wanted cheaper money to buy back their shares and engage in financial operations. And Locke was saying, well, you would be serving their interests by lowering the rate of interest, but you wouldn't be serving anyone else's interest. And then he makes another amusing point where he says that when a country has sort of gone to rack and ruin, the lowering of interest won't actually be of any advantage. That Locke also sort of foresaw as we've experienced since 2008, this period of ultra low interest rates, that it didn't. We see certain parts of society have tremendously benefited. People that Locke identified, the bankers and financiers, have benefited, but not really the wider society.
Well, let's get into some of those specific things as you outlined in your article that I mentioned at the outset. The manipulation of interest rates below their natural level, or our best guess of what that might be, has created the mother of all speculative bubbles, not just in one asset class, but in virtually all of them. But beyond the everything bubble, there are a number of other less obvious consequences. You touched on some that can, I guess, trace their origin to suppressing interest rates. I guess let's just talk through some of those specifically. You mentioned, I think you kind of referred to wealth inequality, and to me, I think
the wealth inequality, which I write about. I mean, you could say income and wealth inequality. I write about that because, as you know, in the last decade, the most popular book on sort of economic history and theory was Thomas Piketty's Capital in the 21st Century. And in this book, Piketty argued that inequality increased when the rate of return was higher than GDP growth. And that was notated as R being greater than G. Now, as you probably know, R is also the notation we use for the rate of interest. And what I argue is that when the rate of interest is kept below the rate of growth, so in a way below its natural level, in inverted commas, then you get asset price inflation. And you can see this in the US in the data of US household wealth produced by the Federal Reserve. And you also get a growth in the financial sector. And you see this in the US data for the size and profitability of what they call the FIRE sector, the finance, insurance, and real estate sector. That after the financial crisis, when you'd have thought that banking was flat on its back, the FIRE sector actually grew to larger level, I think, than ever before, and also contributed both more to GDP growth and a greater share of profitability. Now, if any of us who've worked in finance know that our incomes are to large extent determined not by our innate skill, but by, if you're on the investment banking side, the size of the deals that are going through, and also if you're on the asset management side, by your assets under management. And in particular, when markets rise, fund managers, in general, get a pay rise too. And then we also live in a world in which increasing amount of stock-based compensation, and so the CEOs and senior management also get pay rises when the stock markets are doing well. So I then sort of argue that that Piketty's equation needs to be turned around, that inequality increases when R is lower than G. And we find evidence for that both in the US in the 19th century and specifically with much more detail in the 1920s, and then in the last 3 or 4 decades, where inequality has largely risen in tandem with the decline in interest rates, and you can see, I think there's a chart in the book showing two things. I think it's showing both inequality relative to the total returns on U.S. Treasury bonds, but also household wealth relative to charted next to the Fed funds rate. And as the Fed funds rate has gone lower and lower, household wealth relative to GDP has climbed higher and higher.
Right. And I'm just on the face of it, I've always found it astounding that central bankers can tell us that they're targeting wealth effects, but they're not responsible for wealth inequality. It's astounding to me. But there are other things that are, I think, less obvious consequences or unintended consequences of monetary policy. I interviewed William White on this podcast a few years ago to discuss these, but I think the book does a wonderful job of really analyzing each one of these. You talk about, I think, the pension crisis, and you mentioned unaffordable housing, rapidly rising debt levels, even excess carbon emissions can, trace some back to monetary policy.
But let's stop there for a second. So I think that it is an important point, because there's a chapter on China, and I think it's actually quite an important chapter. There's a tendency, people reading the book and framing it in terms of the sort of Anglosphere and our own particular concerns. But China has also, with its sort of quasi dollar pegging of the yuan to the dollar, has imported easy money from the Fed's easy money policy. It's one of the unintended consequences of the Federal Reserve's monetary policy, and given that, the easy money in China has fed this tremendous real estate bubble, and probably the greatest real estate bubble in history. And then the greatest, alongside that, the greatest investment boom in history, and as we all know, China accounting for near 50% of global consumption of steel and many other raw materials, and more than 100% of incremental consumption growth over much of the last 2 decades, and that has been accompanied by extraordinary carbon emissions. Are you aware that the last 25 years or perhaps 30 years, I think that more than half of man-made carbon, of global warming emissions have occurred since the Industrial Revolution. So it does seem, and that is, so it doesn't seem sort of disconnected. And again, this is another, what it points to my mind, is that if you have if you set interest rates at inappropriate levels, you will have them a variety of strange effects. A very low interest rate encourages the investment in white elephant projects. It often encourages real estate booms. And China, I think, was worked out. Perhaps it's not true, but China was said to have consumed more cement between 2009 and 2012 than the US over the course of the entire 20th century. And cement, as you know, alongside steel, it is one of the most intensive emitters of greenhouse gases.
And I was thinking about it. I've seen some of the statistics around the usage of cement in China, and it's just mind-boggling. One of the other consequences of monetary policy, and I think this is really for me, one of the key takeaways is this vicious cycle for the economy of lowering interest rates below the natural level, which leads to weak productivity, weak growth, because of it allows zombies to, exist in the economy. Capital's misallocated. It just destroys productivity. That leads to a weaker economy, which necessitates even lower rates. And so it's kind of this vicious cycle that we're in.
Yes, I mean there are several streams fill the river of this sluggish river of low productivity growth, and one of them, I think, is that go back to the role of interest as a hurdle rate, as the allocator of capital. If you have very low interest, you will encourage people to invest in projects that perhaps have too low returns on capital. But you also, and some people don't agree with this, but I think many people do, that the very low interest rates are a way of sort of loan forbearance, so that companies that wouldn't otherwise be able to, that would otherwise go bust because they couldn't pay their interest charges or refinance, the capital is trapped in these low return projects or businesses, and that discourages investment in those sectors. It discourages R&D. It discourages employment growth, and perhaps most importantly of all, it discourages new entrants into those areas. I mean, I cite, for instance, Italian cement manufacturers, but you can imagine you wouldn't want to be, of which there are, needless to say, too many, and kept alive by the Italian banks, funded with very low cost financing from the European Central Bank. Well, you might have brilliant ideas about how to revolutionize the production of cement in Italy, but you're simply not going to get financing or enter into that area because there are too many zombies who were likely to keep you out. So, and I think that's one of the contributors of to the decline in productivity, and therefore low interest rates begetting even lower rates. There are other problems. If you think about it, I was talking about the role that interest plays in balancing our present from our future consumption. Now, go back to before the financial crisis, when American households were taking out $500 billion of mortgage equity withdrawal, home loans, based on their inflated housing collateral. And if you remember at the time, the policymakers say, well, look, there's nothing to worry about here. The balance sheets are very robust. Well, they were robust because they were the assets in the balance sheet were at highly inflated levels or artificially inflated levels. But the real problem was that households had taken out, had consumed more consumed from the future, and therefore, after the crisis, they left with too many household debts, and one consequence of that is that their future consumption growth is going to be lower than it would have been otherwise, and consumption, being a contributor to GDP, that you're going to get lower GDP growth. So that's another area in which the low rates beget initially a surge in consumption, but then lower consumption. And then, as I mentioned, the low rates also discourage savings, and savings are, one definition of interest is a reward for abstinence, rather sort of quaint 19th century definition. But for all the talk we heard of a global savings glut, for which, in fact, one can't find much empirical evidence. In the US and in the UK, actually, I'm afraid to say in all the Anglosphere, Australia too, we had sort of woefully low. We've had woefully low levels of savings, and those low levels of savings have have compounded. Well, they've compounded at quite a high rate as long as interest rates were falling, and those were invested, and those savings were invested in long dated assets like equities or bonds, whatever. But the underlying problem was of lack of savings, and if there's a lack of savings, you're going to get lower consumption in future and less investment, and therefore you're going to get lower productivity growth.
Well, to put this, the low interest rates and the kind of this vicious cycle of low rates, low consumption, low productivity, to put it into some kind of historical perspective, you write, quote, "In the ancient world, interest rates charted the course of great civilizations. In Babylon, Greece, and Rome, interest rates followed a U-shaped curve over the centuries, declining as each civilization became established and prospered, and rising sharply during periods of decline and fall. Very low interest rates appear to have been the calm before the storm," end quote. In the book, you really leave it there, but I'm curious to know what your knowledge...
I think, don't I say somewhere, this is hardly a comforting thought?
You do, yes, you do, but you don't really elaborate on that. So I guess I just like to know what your knowledge of history suggests the coming storm might look like.
What might the coming storm look like? As I say, we're talking about these U-shape interest rates over time, and falling to their lowest levels just before a collapse. So, if one was getting sort of very pessimistic, one would say that perhaps we have been at sort of the right-hand side of that U. Another thing that's interesting to note, which I'm sure I mentioned somewhere, is that over the course of the 20th century, and we can throw in the few years of the 21st century too, interest rates have moved to higher levels than ever before in history, but also to lower levels. And that's would seem to be a function of our fiat currency system. At the moment, we're at a juncture that inflation has entered into the system, and the central bankers are trying to keep interest. They're trying to keep interest rates low. They're trying to raise interest rates enough to restrain inflation, but they're also worried, whether they always admit it publicly or not, that a very sharp rate of rise in interest would unravel the sort of the precarious situation we've got ourselves into in recent years of excessive debt, inflated valuations, stuff we talked about. If the central bankers fail in their task, or even inflation might come down, but we might have some further problems, economic problems, and central bankers then put their foot on the gas again. Well, I can see a situation coming about that whereby the inflationary circumstances of the coming years would be worse than we experienced in the so-called Great Inflation of the 1970s. I mean, already people are saying, that in Britain, where I'm speaking to you from, that the inflation, may well hit 15% and come closer to 20%. I'm saying off the top of my head, I think it hit 25% in Britain in sort of 1974, 75. So I think we could be in a position where the system unravels and in a sort of with a sort of inflationary sort of bursts of inflation, and interest rates will have to rise. A friend of mine called Russell Napier, strategist and also financial historian, he argues that interest will be kept below sort of nominal GDP growth in the coming years, and that we'll have financial repression, as it's called, almost, into the sort of median term, and that will actually require the state taking an even greater role in credit decisions, in the allocation of capital. So it's difficult. It's difficult to exactly imagine how things will play out. There's a danger that one can be too sort of doom mongering. But the way I see it is this: is look at those charts on U.S. household net worth, running at, is it sort of 75 or 100 percentage points of GDP above their long-term average, and there is, I have to say, I think there is inevitably going to be a great collapse in household wealth, and that therefore, I think that in 5 years' time, 10 years' time, that any investor who has actually managed to sort of hang on to their purchasing power, as it was at the beginning of this year, may actually consider themselves lucky, because in aggregate, I can't see how that job is going to be done. I think too much of the wealth out there, and this is a point I make, is virtual wealth. I mean, is wealth that is just it exists by virtue of its market price rather than any underlying genuine asset. And that wealth, as we've seen so far this year, is remarkably vulnerable.
Well, that chart of household net worth to GDP is the visual representation of the fact that the stakes have really never been higher for central bankers. But you mentioned, the rise of populism, I think, in the introduction of the book is one of the things you noticed, and people should understand the role of monetary policy and what's going on there. But my, very limited understanding of history would suggest that rising inequality typically gets to a point where redistribution in some form happens. Either that's through policy choices or through revolution. In terms of policy choices, I think about the dual mandate that Congress, gave to the Fed. How much of the situation that we're in do you think really comes down to hubris on the part of central bankers, and how much of it is just smart, well-meaning people pursuing the impossible task of meeting the dual mandate?
Well, I mean, I don't know if you need to refer to it as hubris. I think my own view is that the central banks have the models through which they try and understand the economy and financial system are flawed. And that leads them to make errors, even if they weren't overconfident. I think they did become overconfident in recent years, and frankly, if you have a sort of magic wand that can levitate, trillions of dollars of wealth out of nothing, then perhaps any of us might become a tiny bit hubristic. So I think that there's a problem of the of the models, the underlying problem of understanding economics. So, I mean, I was thinking the other day that, over the course of my career, my interests, central bankers, the economics establishment understood really nothing about speculative bubbles. And then we had the dot-com bust. They understood nothing about credit. And then we had the global financial crisis. They understood really very little about interest. And then we had, this decade of sort of secular stagnation and building up to the latest problem, which is inflation, which again they don't seem to understand very much about. So we really definitely, to my mind, have a crisis of economics. And then, but with the mandate, the mandate of unemployment and price stability. There may be, and these are, I think the problem is really over what time period you wish to implement this mandate. That my criticism, I think it's the same that say Bill White, who you mentioned, who used to be chief economist at the Bank for International Settlements. I think the argument Bill would make, and I think that the argument also made by economists at the Bank of Japan, who looked back upon the bubble economy of Japan in the 1880s, which occurred when inflation was very low, and the argument has been that, well, you need to actually, it doesn't say in the mandate that you should be thinking about immediate inflation or trailing inflation, but you should actually you should think of it over a longer period. If you think now, look at the central bankers today. 2 years ago, if you remember, Jay Powell was saying he wasn't even thinking about raising interest, and the policy establishment were talking about inflation expectations or inflation fundamentals being well anchored and no risk of inflation. Then it takes them by surprise. So you could have said, well, if they had both the right model and the right time frame, then perhaps they could have delivered. They could have delivered, done a better job. The other point, as you know, I make in the book, is that I think the fuss that central bankers have made about deflation is that falling price level is completely wrong. They got hysterical about the risk of deflation. Well, the average working person, frankly, doesn't complain when the computer or the price of beer or the car costs less one year than another. Deflation makes one better off, providing one's income hasn't shrunk. As far as I can see, the great losers from deflation are corporations. So the point is that I think it's misunderstood the nature of deflation. There are good deflations and bad deflations. There's good cholesterol and bad cholesterol, and the good deflation comes when you have productivity improvements that lower the prices, that make people better off. It means that their spending goes further, and we had that good deflation. Frankly, as a result of globalization, as far as I can see, and from some technological improvements. But the central bankers used that good deflation, was spooked at that good deflation into lowering interest rates, fueling the asset price bubbles and credit booms. That then, when they bust, they give you the bad deflation of an economy that contracts when, and a money supply that contracts when everyone tries to pay off their debt, having realized they've got into too much debt. So I think that there needs to be a sort of deeper understanding of both the nature of inflation and deflation. And you think now, people complaining about the cost of living crisis. Well, no one was complaining, frankly, when price level was relatively stable and year-on-year price changes were there was no movement year-on-year in the consumer price index. Only the central bankers who use that as a pretext to engage in monetary policy experiments.
Well, there was the fear of the zero lower bound, and what it does to the efficacy of monetary policy and all that stuff. But obviously the book makes a wonderful case for at least giving some more credence or appreciation for the unintended consequences of discretionary monetary policy. At the end of the book, you seem to express that there may be some hope in the form of a central bank digital currency. Would you briefly outline that idea for us?
So, go back to our discussion about the natural rate. When John Locke was writing about this in the 17th century, there was only a very limited banking system, and the gold and silver were the basis of the currency, and you can't increase the amount of gold by waving a wand. And so that, I think that meant that the interest charge was more closely related to, if you will, the market forces determining the demand for credit and the supply of credit. Then you move into a fiat money world where money is created both by central banks, but also by commercial banks by making loans that end up as deposits in the banking system. Well, then really you can see that if there's no sort of finite supply of money, then the interest charges are always going to be somewhat random or somewhat set by some policy criteria. And in a way, and I suppose if one's being pessimistic, you're going to say that no one is ever going to to fully understand the financial system well enough to set a perfect rate. Just as if I asked you to price some random article, I don't know, I've got a microphone in front of me. You wouldn't know how to price that, because even if you took into account all the parts that went into it, in the end, it's best left to a market to price these things. Now, this is just an idea. If we move to a world in which, I'm not saying moving back to a gold standard, because there were problems with the gold standard, but if we move to a world in which, let's say, a central bank digital currency became the basis for money, and that banks no longer, financial activity would then consist not of creating money, but of lending this, if you will, scarce resource, and you could mandate to increase the amount of money in the system by, I don't know what, some assumption of GDP growth plus perhaps a tiny bit of nominal inflation if you insist on some inflation. So let's say this currency, this money increases by 4% a year, but with a hard break on that automatic increase. Then I think there would be a better balancing. The price of borrowing this genuinely scarce resource would more truly reflect actual supplier savings, deferred consumption, and the demand for those savings, actual investment. And I'm not saying, I don't really elaborate it in the book, but I don't think this would lead to a world that was free of booms and busts. But it might be a world in which we didn't see quite such extremes of interest rates, either high or low. It might be a world of price stability over the long term. But the main problem with that idea is that you'd have to change the financial system. Frankly, banks, if you went down the system, banks, would lose their deposits. They would cease to operate as they have done. They would have to be more intermediators of money. I think that I think that the financial system has sort of huge lobbying power, and really we would only go down that route if our monetary system had completely failed. So I don't think you're going to get there unless except at the end of really a worst case scenario that would end with a need for a systemic monetary reform.
Well, it's an interesting idea. I think my favorite quote from the book is America's central bank exercises power without responsibility. And it seems like this is an idea to begin.
If I'd been more polemical, I would have said, I would have added the full original quote, which I think is the prerogative of the whore throughout the ages.
That's right. And I think I think it's a great idea we need to start talking about these things and coming up with ideas, because I think we are probably at a point in time with the rise of populism and inequality where we're hopefully going to see some change at some point in the future. But The Price of Time is a fantastic read. I just think it's a must read for investors. You've been very generous in sharing your time with me today. Where can people go to learn more about you or just keep up with your latest work?
Well, I have my own website, and then I write a column for Reuters Breaking Views, which goes out on the Reuters website. So that is, those two places you'll see sort of more or less what I'm doing.
Okay, and I'll have a link, a blog post up on my website with the links to your book and all of these other things we've talked about at thefelderreport.com. Edward, you've been so generous with sharing your time and knowledge with me today. Thank you so much.
Thanks, Jesse. It's been fun.
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and links related to this episode at thefelderreport.com. Thank you for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.